Every country is in debt. The United States counts tens of trillions. The European Union and Japan, too. Even oil powers and export champions borrow. So if everyone owes, who gets paid? Welcome to the Money Chronicle, where history meets economics and simple stories fall apart. Debt isn't just a weight, it's infrastructure. Wars, crises, booms, stimulus, all of it sits on a lattice of written promises. Follow those promises far enough and you find something counterintuitive. The world largely owes itself, but the benefits and burdens are not shared equally. The modern version begins in war. In 1694, England was running short of gold against France. Merchants advanced funds in return for interest backed by future taxes. To administer the deal, the Bank of England was born. From then on, the state could spend today and spread the bill across time. Lenders received a transferable claim, the government bond. France copied the model, the Dutch refined it. The United States used it to finance independence, then westward expansion. Debt stopped signaling weakness and started measuring credibility. Empires no longer needed to seize bullion, they could place bonds. The battlefield shifted to the balance sheet. Who then holds the other end of the rope? In the United States, a large share of federal debt is market-held, and most of that is owned by Americans themselves. Pension funds, banks, insurers, households, and the Federal Reserve. Foreign investors, Japan, China, Europe, own a slice too. But most interest payments remain domestic. The same circularity appears everywhere. Japan buys treasuries. Europe lends through the IMF. Emerging economies park reserves in Western bonds. Those same issuers buy emerging market debt. Not a single villain, but a web of promises. Behind that web sits a market most people never see, the market for collateral. For pension funds, hedge funds, central banks, and sovereign wealth funds, top-quality government debt isn't just a safe haven. It's the key that unlocks funding, repo markets, and liquidity. Paradoxically, if some governments repaid all their debt, finance would face a safe asset shortage rather than a windfall. Central banks don't create value from thin air. They swap. When the Fed or the ECB buys bonds, it credits the system with base money and takes longer-dated assets in return, turning long debt into very short-term liabilities on its balance sheet. One balance sheet's liability becomes another's asset. Modern money is both a claim and an obligation. Why doesn't sovereign debt go away? Because governments roll it over. They issue new securities to retire old ones. The real question isn't pay it all back, but service it sustainably. Here's the quiet rule that matters, RG. If the average interest rate, R, stays below nominal growth, G, the debt burden shrinks relative to the economy. Add inflation, the maturity profile, and the tax base, and you get sustainability, not a raw number on a screen. When does it break? When confidence breaks. Greece, Argentina, Sri Lanka, once investors doubt, yields spike, currencies slide, and budgets are consumed by interest. Austerity bites, economies contract, then come restructurings, new loans, and eventually renewed belief. Modern public debt is designed not to vanish, but to roll. We owe it to ourselves is only half the story. Nationally, much public debt is an asset for residents, your savings, your pension. But interest flows are uneven. They rise from taxpayers to those who hold the claims. Internationally, some nations are net creditors, others net debtors. Things don't simply cancel. Look at today's balance sheets. Aging populations push pensions to seek predictable income. Banks need safe collateral to grease daily funding. Tech booms and energy transitions demand long-horizon capital. All three forces pull in the same direction: steady sovereign issuance at reasonable cost. That cost depends on trust in institutions, in tax capacity, and in a currency that holds its value. That's why the question isn't, can we repay everything? It's, who owns the debt? At what rates and maturities? In which currency? And how resilient is the buyer base when volatility hits? If R stays below G for long enough, the burden lightens. If R outruns G, interest can crowd out investment and social priorities. Debt is not destiny, it's design. Well-designed debt spreads risk across time, funds useful projects, and anchors the financial plumbing as high-quality collateral. Poorly designed debt concentrates risk, amplifies inequality, and collapses when confidence thins. 3 lessons endure. Structure beats size. The mix of maturities, currency, and investor base matters more than the headline total. Institutions are collateral. Independent statistics, credible budgets, and a predictable legal system are as valuable as gold. Growth is the solvent. If economies can innovate, educate, and productively invest, R-G does the quiet work that politics can't. Every country is in debt, but the true creditor is confidence, the belief that tomorrow's promises will still trade at par. Keep that, and the system hums. Lose it, and numbers stop being abstract. If this gave you a clearer view, subscribe. The history of money explains our present and our future. We'll show you where to look.